I'm your host, Sierra Hoffman. And on today's call, we have August Biniaz of CPI Investments. So thank you so much for being on the show today.
Absolutely, my pleasure.
Perfect. So, as usual, I like to start by knowing more about you and your story. So, tell us what you did before and how did you get into commercial real estate?
Yeah, no, absolutely. I started my career in real estate close to 17 years ago. I was started as a licensed agent. My mom told me, "Hey, you should check out this gig of being a real estate agent. All you do is you list people's homes on MLS and it sells and you make a commission." So I got into the space. It didn't really work out that way. There's a misconception about how much work there is to be a real estate agent. But what I realized soon, I wasn't really good at being a broker, but I was great at finding deals and sourcing deals. And
Hmm.
soon I started a general contracting company, buying single family homes and renovating them and selling them. Eventually moved on to building single family homes from the ground up, spec homes and custom homes. Spec homes is the homes you're building and you sell it to the market. Custom homes is when a consumer hires you to build them a home. So I was doing both of that. Always wanted to scale, and I was in that space for over a decade, and a deal came across my desk. It was a 5 single family home land assembly where you could buy those 5 single family homes it was on a major road here in Vancouver, and you could build townhomes on that project. It was an $8.7 million acquisition price, another probably 7 or 8 million for construction. I didn't have the equity to be able to purchase that project. So I went, but it was a great, tremendous deal because the person who had that project under contract was in a little bit of a distressed situation. So I went to my group of investors, my network, and I was able to raise $5 million and bought that place. And my agreement was that I also put up some of the equity as well, but it was a very small percentage. And the agreement was that I would manage the project, not as the GC. I would hire the GC. I would hire all the professionals. I'll oversee the project, and I would get a percentage of the total project, the profits when the project was built and sold. I fell in love with that model, that concept, that idea of finding the deal, finding the investors, hiring all the professionals involved, and getting compensated relative to the performance of the asset. So I just wanted to scale that business more. And that was my start into seeking private equity, or even realizing that there is a way to raise capital to do real estate projects. But my plan initially was to focus on ground up development projects here in Vancouver and the surrounding areas in the west coast of Canada. But as I was educating myself on similar platforms such as yours, most of that content was coming from the US.
Yeah.
And the business model people were utilizing was the value add business model, meaning that the structure was already built, the asset was already stabilized, it was producing cash flow. And these groups were going in, buying already cash flowing assets, doing some small upgrades, lipstick renovations, increasing the rents, in turn, increasing the asset's value because they increase the NOI. And as I'm sure you're aware, commercial real estate is assessed on the income approach, not the comparable approach like single family. So that was my start into this new space of the US multifamily, value add, real estate private equity. And I got the bug, and I just, especially when you compare it with ground up development and so much risk associated with ground up project when you're dealing with environmental issues, construction, contractors, dealing with a city bureaucracy and rezoning and public hearings and entitlements. Buying an already cash flowing asset makes so much more sense. And that was my start. I partnered with my partner to start CPI Capital, which is a Canadian based real estate private equity firm focused on US multifamily, focused on providing exposure to
Mhm.
Canadians to be able to invest in US and in a very streamlined process. But I'll stop there and allow you to ask further questions.
Yeah, and I'm very interested in this business model because I am Canadian. So I've only been in the US. I moved here, what is it, end of 2014 to get married to my husband because he was American. And I've been here for a short amount of time. And so all of my friends and family, a lot of connections I have are Canadian. And I think it's very difficult for Canadians to navigate this space and figure out how they can invest in US multifamily. There seems to be a lot of challenges with that. So can you speak into what are some of those challenges and how have you been able to overcome that and basically create a company around it?
Absolutely. Let's break it down in two ways. So, one, when we're talking about investing in real estate, there is such a large ecosystem. There's many different ways to invest in real estate. let's say you have, and you're not talking about cross-border investing. So you have Canadians who believe in US real estate, believe in multifamily. So they have an option on investing directly, coming to the US, purchasing a property, getting debt if it's from a US institution or a Canadian institution, and buying that property. That option always exists for Canadians, and the process is very streamlined. The US is very welcoming as a capitalistic country, right? But when you're talking about raising private capital from Canadians to then invest in US real estate, that now opens the door for a lot of concerns and hurdles and regulatory issues that you have to abide by. So it makes things much more complicated, especially if you're also looking to raise capital from US investors. So
Mhm.
that was a process that we had to go through, a lot of blood, sweat, and tears learning the process, because just because somebody has a title of being a lawyer or a CPA, that doesn't necessarily mean they know everything in the space. We had the conversations with probably close to 40 lawyers and CPAs and
Wow.
tax strategists to come up with the best process to allow Canadians to invest, for
Mhm.
Canadians to be relieved from double taxation, for them to be relieved from having to deal with the IRS, because people are already in Canada dealing with the CRA, Canada Revenue Agency. Now they have to deal with IRS as well. That becomes more cumbersome. So we had to navigate the steps through that. And I can get into that. But yeah, just differentiate someone in Canada looking to buy US real estate, or
Mhm.
someone in Canada looking to passively invest as a limited partner in a
Right.
US fund or a US syndication with either a Canadian entity or a US entity. So those are important to separate.
Mhm. Absolutely. So, as a US person investing in a US multifamily, being a limited partner, it's very easy for them. Usually, the minimum is about $50,000 to get into a US multifamily syndication deal. What are the amounts, or how can someone that is in Canada invest in US? What are some of the things they have to go through?
Yeah, as far as the offering, as far as the returns available, the minimum investments and returns, Canada and US are somewhat similar. I would say US has higher yields. So most US sponsors or investment firms provide higher yields to their investors. The yields are less in here in Canada. So that's one differentiating factor. Aside from that is also, as far as now, most deals in the US are structured in a LLC, a limited liability corporation, right? It's very common. It's become sexy. That's the entity people use. In Canada, we don't even have LLCs. We either have corporations or limited partnership. We don't have this hybrid entity like the Americans that you people in the US do, but LLCs are very common. Unfortunately, LLCs are not very tax efficient entity for Canadians looking to invest,
Mhm.
because as limited partners in a LLC in the US, any type of distributions or profits that come back to the Canadian investor are looked at as dividends. They're not a flow through entity like a limited partnership. So that's one cause of concern, because most deals are structured in LLCs, not limited partnerships. So that's one concern. The other concern really is, how big is this pool of investors? Is it a single investor that's going to be investing in a US deal, syndicated deal in the US, be it multifamily or other asset classes? And is it worth it for the sponsor to be able to structure their deal in an inclusive way to allow this Canadian investor to participate? So that's one concern. The second concern is compliance. Obviously, there is the SEC in the US, Securities and Exchange Commission, who looks after all the regulation and when it comes to capital raising and dealing with investors. Canada also has our version of the SEC, which is the provincial securities commissions. Every province, like our version of states, has its own securities commission. So the second item that an investor or the sponsor has to look at is, are they following all the rules and regulation when it comes to the SEC and the provincial securities commissions across Canada? Third item that the sponsorship has to look at is taxation.
Mhm.
When a US investor invests with a US sponsor, every year they provide them with a K1 that shows their profit and losses and distributions and other important points. Well, a K1 is a non-existent form. A Canadian investor can't use that form to file their taxes in Canada. The equivalent of that form is a T5013, which is our version. So that form, that K1 has to be converted into T5013. That's a cost for the investor. So these are issues that exist. And over the years, I've heard from a lot of different investors that they've invested with a US sponsor, but the deal was structured in LLC and now they're being double taxed. They're not only paying taxes on the US, any returns that come back, those taxes are in the US are not being recognized by the CRA, but they're also paying taxes in Canada as well.
Yeah, you definitely want to avoid that. So the way to avoid that is how?
Yeah, so it really depends on the sponsorship group. Like, for example, you're a great example, right? You've lived in Canada, you have family and friends here, you're now in the US, you are a thought leader, you're involved, you believe in this asset class, and you want to allow your Canadian investors to participate in your deals. So the first question is, how are you structuring your deals in the US? Are you using the 506C or 506B offering? So, for example, if you're using the 506C, you can only allow accredited investors to participate. So if you're raising funds from Canadian investors, you got to ensure that they are also accredited and they can prove that either through different means that exist. And then you also have to abide by the regulation that exists in every province you're going to be raising capital, because every province has different sets of regulations and rules. Moreover, what is the entity that you're going to be structuring your deal in? Are you also creating a project specific fund here in Canada? Obviously, you have to create a project specific fund in the US, for example, a limited partnership, which your asset is going to be owned. So those are the questions you have to talk with your tax specialists, cross border tax advisors to figure out what's the best process. But it all depends on how many investors you have and is it worth it for you and
Yeah.
your group to bring on these group of investors who want to participate. But there is definitely ways to achieve that, and it is doable.
Yeah, so there's just more challenges to overcome when you are dealing with Canadian investors in a US syndication. And so, given that, the way that you structured your company, are you always finding your own deals or do you partner or look for someone in the US that has a deal and help raise capital that way? It just seems that maybe you already have enough resources, the legal and the tax things figured out on your end to be able to do it. Just finding your own deals might be a little easier
Great,
or
great question. Yeah. So this is great for LP investors, limited partners to hear how do firms get built and scale, but it's also great for people who want to get into the space of real estate private equity and these passive real estate options that exist. So when we first started CPI Capital, our focus was mainly allocated to capital raising, building a brand around ourselves, building a brand around our company, investor relations. That's where our focus went around really the equity. So we were overextending ourselves as a smaller firm to also be focused on sourcing deals, underwriting deals, asset management, which also there's a whole department needed for that. That's why to be able to build a track record, to be able to have a proof of concept, we decided to partner with other groups in the US, other lead sponsors, other general
Mhm.
partners. And on a co-general partnership, basis, we partner with them to add value to the deal, bring some investors, bring our brain power to close on the deal. So that's how we started. And we closed on 3 deals in that structure. And now we've moved on to be able to do deals on our own as the lead sponsor, opening the door for other general partners so they can join forces with us. So both Canadian co-GPs or US co-GPs can join forces with us to be able to close on larger deals, and we can all leverage each other's experience, knowledge, and track record.
Perfect. All right, that makes sense. So, just for some people who maybe not know exactly what it means, but what is real estate private equity?
Real estate private equity. So to be able to break down real estate private equity, let's break down what is private equity. A lot of times you hear this expression private equity. There's a YouTuber who runs up to people's fancy cars and he asks them, "What do you do for a living? How did you make all this money to buy this car?" And a common answer is private equity. But private equity is this very broad term. What is private equity? Private equity is a process that groups use to be able to purchase companies, either publicly traded companies or private companies, and they raise private capital to do so. And the business plan really there is to make the company more efficient through either mergers or acquisitions, and then to then sell the company at some point and pay the returns back to investors. That's the whole concept of private equity. Now, private equity real estate or real estate private equity is the same process as raising private capital to be able to buy real estate assets. So it's a large encompassing ecosystem that allows capital raising. In most cases, these deals are structured in a limited partnership where there are limited partners who are basically the silent partners, the investors of the deal. They're called limited partners because they have limited liability. And then there are general partners, basically the captain of the ship, the sponsor, the people who put the sweat equity and find the deal and execute the business plan, and they have unlimited liability. So all the liability is on them, and they come together and they're able to do deals together. So that's essentially what real estate private equity is.
Perfect. You mentioned early on in the conversation, you talked about syndications. And I just want to delve into what is a syndication versus what is a fund? What are the pros and cons of either of those models?
Yeah, great. So it really starts with the business plan, right? So for example, yourself, your business plan is to, I'm assuming, is to buy multifamily, right? But how are you going to structure it? Like, what are people investing in? What are they receiving? At the most basic is a joint venture where two, three, a few people get together, they put up their money, they put up their knowledge, and they do a deal together. They got similar liabilities, right? So that's just a joint venture. The next step is a syndication where you have the general partner and the limited partner, and it's a project specific deal. So it's one deal, it's 100-unit apartment building that you and your group have found. You structure that deal in a limited partnership, you offer it to your investors, invest, and then you execute the business plan. The next step after that is really a fund. A fund is basically a basket of multiple deals. And the timeline, the journey is much longer because you can continuously raise capital into this basket, and then you can continuously buy different properties, different assets, which are all hold within this basket of real estate assets. So that's a fund. And then the next step after that are REITs, real estate investment trust, which are either public or private, but public REITs, you can buy bits and pieces of these investments, which your investment is diversified amongst multiple properties. So that's basically the spectrum. You have joint ventures, you have syndications, you have funds, and you have REITs. These are the main structures that can be used to buy a piece of real estate and execute a business plan.
Perfect. And what would you say if someone is considering how to get into their deal? Maybe they're an active investor, and they could be a passive investor, and they're deciding between should I invest in a syndication or should I create a fund? Which one is better in your opinion?
Yeah, I'll give the view from both sides, from a passive investor and an active investor as well. So for an active investor, my advice would be if you have not syndicated a deal yet, my advice would be definitely syndicate a deal, either yourself as a lead sponsor or partnering with another lead sponsor, understanding all the steps and what have you that goes into doing a deal, building a track record for yourself, and then starting a fund. So that would be my advice when choosing between the two. As a passive investor, that question really depends on you personally. Funds usually is illiquid, and the funds are locked up for at least around, let's say, 7 to 10 years. Syndications, the turnaround is quicker. Is also the returns on syndications are higher than they're on the funds because syndication is one deal, whereas in a fund, your investment is diversified amongst multiple projects. So if a project is doing really well and another project is not doing so well, that your pool gets aggregated between those assets. So the returns are lower, but also the risks are a bit higher for syndicated deals. So it really depends on the investors' plan, their goals, how much they're looking to invest, how long they're looking to have their money locked up for. It goes back to them to then decide are syndication right or funds. They could also diversify. They could invest in funds and they could invest in syndications.
Absolutely. So we're into 2023 right now. I think a lot of investors, maybe they're still sitting on the sidelines, they're unsure about the market. Can you tell us about your current investment strategy and has it changed this year?
If I can sum it up in one word, it would be opportunistic. So we are opportunistic. We're watching the debt markets and the capital markets very closely. The Fed just increased the interest rates by 25 basis points. They are forecasting that they will continue increasing interest rates. The reason the Fed is increasing interest rates is because the inflation is very high. And one of their main way they can combat inflation is by increasing interest rates. They increase interest rates, the cost of capital goes up. Real estate companies don't buy real estate. Other companies looking to grow don't borrow money. And that shrinks the economy, that reduces growth. And by reducing growth, the inflation numbers should come down. The other difficulty that they currently have is the job numbers are very strong. So inflation, when the jobs numbers are strong, inflation numbers are difficult to bring down. So we're watching that aspect very closely as far as the debt market, knowing that we're still in an increasing interest rate environment. So it's a choppy environment. You don't want to be in an environment that your rates are still increasing and you buy real estate. So that's something we're looking at closely, but there's always opportunities that exist. For example, there is a way to purchase properties with assumable loans, right? So if somebody has a loan, it's a fixed rate, a long-term debt, and you can assume that on purchase, but those deals are far in between. Also, we know at some point the Fed has to stop increasing rates because the economy might shrink too much and we might end up in a recession. So we're also focusing on ourselves, on our company, building our team, going over our acquisition prices, underwriting a lot of deals. So when the market does turn, we'll be one of the first people who can enter back into the market. So that's where we're really at. We're looking also at the regions. What is the regions we want to be focusing on? So when the market does shift, we can go back into those regions. That's basically our focus currently.
Do you have any particular regions that you're focused on?
I'm personally motivating our company. I'm personally very bullish on Florida. You have Jacksonville, Orlando, Tampa. You have the state of Florida alone has a bigger economy than the whole country of Canada. So it's
Wow.
just mind boggling. It has more international airports than the whole country of Canada. And you can drive anywhere in the state within 4.5 hours. The interstate migration, people moving from New York and other states into Florida is huge. So very bullish on Florida. Texas is another, obviously, it's a giant. Texas on its own, again, has a larger economy than the country of Canada, the country of Russia, a lot of people moving there. So we're very bullish on these Sunbelt states, Florida, North and South Carolina, Georgia, Texas. But my topic would definitely be Florida. And that's where we're currently aggressively looking at deals, connecting with brokers. Another quick thing to mention is now that the market has slowed down a bit, and for active investors looking to get into the market, connecting with the right brokers
Hmm.
is one of the most important aspects of the acquisition process of your company. So now that they're not that busy, it's a great time to connect with brokers, getting to know them, getting on their list. And that's one of the strategies that we're doing currently.
Absolutely. Yeah, now that brokers don't have as much people reaching out to them, now it's a good time to build those relationships, make those contacts. And then when the market does pick up and you get a lot more activity, you're the first person on their mind, right?
Exactly.
So I'd like to switch gears a little bit here and walk through one of your deals that you've done. Maybe it could be one from the very start or just one that was more challenging than the others. And tell us about how you were able to find that deal, what kind of lessons you learned from that, and things that our listeners can take away from that.
Yeah, absolutely. I'll tell you guys about the deal. An advice that came from my good friend and our lawyer, Dugan Kelly. He's like, sometimes the best real estate deal you're ever going to do is a deal you never did. And I was telling the story where we started partnering with other lead sponsors to be able to do deals because we didn't have the infrastructure yet. We didn't have the acquisition and asset management side of the company. At some point last year, we decided that we're no longer going to be doing deals with other sponsors, that we're going to be the lead sponsor. So we went on a
Mhm.
hunt for a deal. And there was a deal that we found, which was a build to rent, a single family rental. It was 71 single family homes we were purchasing in Tucson, Arizona from a developer. And it was a great deal. But from the day that deal came across our desk to the day that deal eventually collapsed, the interest rates went up, over 500 basis points. The
Wow.
Fed's funds rate alone went up over 300 basis points in that time. So we learned a lot from that deal. Some of the quick lessons learned I could tell you is that that deal, it was a build to rent. I believe in the build to rent asset class, and we will 100% do a build to rent deal at some point because it's a superior asset class to multifamily. There are single family homes in a community that just behave just like multifamily. So long term, I believe in that asset class, but we were early into that space. Most of our investor community were familiar with multifamily and the economies of scale that existed. We were having a difficult time explaining what this BTR SFR asset class was.
Yeah.
We deviated from the mandate, we deviated from the plan. So that's one lesson that we learned, that you have to, trying to get into an asset class early on was a bit difficult. Another thing is looking at the markets closely, knowing that interest rates are starting to go up. That wasn't our fault really, but to be more focused on where the interest rates are. And maybe we could have walked away from that deal sooner. We eventually did walk away, but we could have done it sooner. We didn't raise any money from our investors, but we still sent out a deal to our database and had soft commitments. And moreover is the project wasn't built yet. So people couldn't touch it, feel it. There was no proof of concept. It was all assumptions. And investors are not as comfortable investing in something that there's no proof yet. So those were other lessons we learned. And so, yeah, if there is a recent project that we learned lots from, it was for sure the BTR SFR project in Tucson.
Thank you so much for being on the show today. Where is the best place for people to find you online if they want to learn more about you and how they can work with you as well?
Of course. Yeah. Our website, cpicapital.ca. I'm very active on LinkedIn, and I believe I'm the only August Biniaz on LinkedIn so far. So connect with me on LinkedIn. Tell me that you've seen me on this show, and happy to connect and add value.
Awesome. And I'll make sure to include links to both of those in the show notes below. So thanks everybody for tuning in today. If you guys enjoyed today's show, please write us a 5-star review on Apple Podcasts or Spotify. Every review helps us to be able to reach more and more people looking to get involved in commercial real estate. If you're looking to level up your investment game, join the Commercial Real Estate Bosses community. It's completely free, and inside you will get access to our Passive Investing 101 Masterclass, as well as regular live trainings where you can ask questions, and access to industry professionals and like-minded investors. Join for free today by going to crebosses.com/join. That's crebosses.com/join. Or click on the link below and I'll see you